Almost exactly 1 year ago, the US banking system suffered a major blow when three major banks, Silicon Valley Bank, First Republic, and Signature Bank, all collapsed within a short period of time. When these banks collapsed, their assets and liabilities were taken over by the FDIC, a government body which protects depositors and handles bank liquidations. When the FDIC has to take control of a failed bank, their goal is to sell as much of its assets and liabilities to a healthy bank as soon as possible. In the case of Signature Bank, the FDIC agreed to sell most of its assets and liabilities to another bank called New York Community Bank, or NYCB. This was viewed as a huge win for NYCB because the FDIC gave them favorable terms. Also, the fact that the FDIC trusted them signaled confidence to the market. By the summer of 2023, NYCB's share price surged to more than $13, as they came to be viewed as not only a survivor, but a beneficiary of the banking crisis. Everything seemed to be looking good for NYCB until early 2024, when they reported an unexpected $250 million loss. This came as their loan portfolio, which is heavily concentrated in New York City residential apartments, started to show severe signs of stress. By March of 2024, the situation got so bad that NYCB was forced to raise $1 billion from an investor group led by the former Treasury Secretary Steven Mnuchin. This dilutive equity raise valued the company's stock at just $2 per share, 85% less than where the stock traded less than a year prior. For the past year, many analysts have been sounding the alarm about office buildings. With work-from-home trends, many office buildings are suffering from low occupancy, and many landlords are starting to default on their mortgage payments. What's surprising about NYCB is that their problems are not coming from office buildings, but instead from residential apartments, which were previously considered to be much safer. In this video, we'll look at the recent problems facing NYCB, and whether the FDIC made a mistake when they sold them the assets of Signature Bank. The unexpected downfall of New York Community Bank shows how unpredictable and chaotic the world can be. It goes to show that nothing in life should be taken for granted, especially those who you care about the most. That's why it's so important to make sure your loved ones are taken care of in the event that something happens to you. That's where today's video sponsor Policy Genius comes in. Policy Genius is your one-stop shop to find and buy the insurance you need at the right price. With their licensed, award-winning agents and technology, they make it easy to compare quotes from America's top insurers to find your lowest price. With Policy Genius, you can find life insurance policies that start at just $292 per year for $1 million of coverage. Some options offer same-day approval and avoid unnecessary medical exams. Importantly, Policy Genius works for you, not the insurance companies, so they're not motivated behind the scenes to push one insurer's policy over another. They just look at your situation and find the policy that's right for you. They already have thousands of 5-star reviews on Google and Trustpilot from customers who found their best policies. So if you have anyone who depends on you and you want peace of mind, provide them with a financial safety net using Policy Genius. Head to policygenius.com/WallStreetMillennial or click the link in the description to get your free life insurance quotes and see how much you could save. And now back to the video. NYCB primarily lends money to real estate investors who buy multifamily apartment buildings in New York City. Much of their lending focuses on so-called rent-stabilized properties. We'll get into what this means later in the video. Historically, NYCB has been very conservative in its lending practices, only giving loans to landlords with strong balance sheets and offering relatively low loan-to-value ratios. Because of this, they historically had pristine credit quality. We can see this by looking at their net charge-off ratio. Net charge-offs is a banking term which describes how much a bank loses from defaults. The net charge-off is the amount of loans that default, minus any recovery the bank receives. For example, let's say you have $300,000 outstanding on your mortgage and you default. The bank will repossess your home. The bank recognizes a gross charge-off of $300,000. But this isn't their net loss because they can still repossess and sell the house. Let's say they end up selling it for $200,000. In this case, the net charge-off would be $100,000. NYCB has historically had among the lowest net charge-offs in the industry. Most banks suffer net charge-offs of roughly 0.5% of their loan book each year. During times of stress, such as the 2008 global financial crisis, net charge-offs surged to almost 3%. NYCB, on the other hand, had zero or almost zero net charge-offs in most years. Even at the peak of the global financial crisis, their net charge-offs peaked at just 0.35% of their loan book. Thanks to this track record, NYCB gained a reputation as a conservative, well-managed bank. This reputation helped them land a lucrative deal to acquire Signature Bank's assets in March of 2023. Signature Bank was a New York-based bank with a little less than $100 billion of assets. In an attempt to grow, they welcomed over $16 billion of deposits from crypto-related companies. By March of 2023, crypto-related deposits represented about 20% of their total deposits. Following the collapse of Silicon Valley Bank, many of Signature's crypto-related customers started withdrawing their funds, leading to a bank run. Many of Signature's assets were long-dated loans and bonds, which had suffered mark-to-market losses as a result of the Fed's rate hikes. Thus, even if they tried to liquidate their assets, they wouldn't have been able to honor all of their withdrawals. So the FDIC took over the bank, wiping out its shareholders but making sure all depositors would be made whole. The FDIC's plan was to sell off all of Signature's assets to pay back depositors. Any shortfall will be covered by the FDIC's own funds. The FDIC is not in the business of operating a bank, so they wanted to either sell it off or wind it down as quickly as possible. This opened an opportunity for NYCB to score a favorable deal. NYCB agreed to acquire $38 billion of Signature's assets. This included $25 billion of cash and $13 billion of loans. In return, they would take on $36 billion of liabilities, most of which being customer deposits. The value of the assets exceeded the value of the liabilities by $2 billion. Importantly, this deal excluded all of Signature's crypto-related assets and deposits. The market viewed this very favorably. NYCB was able to book a $2 billion windfall without needing to touch Signature's troubled crypto business. But 1 year later, NYCB's stock price is down more than 70%, and they were forced to seek a dilutive bailout. So what went wrong? The current problems facing NYCB have nothing to do with its acquisition of Signature's assets. The loans they acquired from Signature were construction and industrial loans. NYCB's problems come from its New York residential loan portfolio, which long predates the Signature deal. To understand what's going on, we first need to understand the New York residential real estate market. Rent in New York is high. According to RentHop.com, the average rent for just a studio apartment in the city is about $3,300 per month. After a brief dip during the pandemic, rents rebounded and now far exceed pre-pandemic levels. The rise in rent prices is a bit surprising given the trend of working from home. Many people who used to live in New York because of their job can now move to suburban locations which have much cheaper costs of living. We know that many employers still allow their employees to work from home because office building occupancy has remained stubbornly below pre-pandemic levels. According to estimates by the US Census Bureau, the city's population has declined by 6% between 2020 and 2023, from 8.8 million to less than 8.3 million. Given that this is the case, why are rents still rising? New York City is still housing constrained. Many people live with their parents or with roommates because they can't afford to rent a place on their own. Thanks to the post-pandemic economic boom, wages across the country have risen strongly over the past 3 years, including in New York. The median income in the city has risen from $2,867 per month in 2020 to $3,300 per month in 2022. We don't yet have data for 2023, but it is expected that they continued increasing. The increase in rent is pretty much in line with the increase in wages. New York residents bid up the prices of the city's limited housing supply to whatever they can afford. If you look at this chart, the average rent for a studio apartment is almost as much as the median income. This is an apples to oranges comparison because it's comparing the average to the median. The median rent is much lower, as the average is pushed up by luxury apartments in Manhattan. Regardless, rent is still extremely unaffordable in New York, despite a modest decline in the city's population. But why is this bad for NYCB? They lend money to residential landlords. Shouldn't rising rents be a good thing? Rent has been unaffordable in New York City for a long time. Because of this, the government has long implemented a rent control policy called rent stabilization. Rent stabilization applies to most apartment buildings with at least 6 units that were built before 1974. Currently, about 45% of rental units in New York City are rent stabilized. A government commission decides how much rents can increase per year. This is usually between 2 and 5%. However, even for rent stabilized units, the landlords still have some ways to increase the rent. At least this was the case in the past. When the tenant moves out, you can raise the rent by 20% for the next tenant. Additionally, for every $40 you spend on renovations, you can increase the rent by $1 per month or $12 per year. Thus, the renovation will pay for itself in just 3.5 years. Once the rent reaches $2,775 per month, or if the tenant's income surpasses $200,000 per year, the unit becomes unstabilized. This system created an incredibly lucrative opportunity for landlords. Rent-stabilized properties sell for a significant discount to equivalent non-stabilized properties. A landlord can buy the property, gradually increase the rent via tenant turnovers and renovations, and eventually turn it into a non-stabilized property which they can then sell for a much higher price. Landlords would typically take out mortgages to purchase rent-stabilized properties. NYCB is one of the biggest players in this market. Of their $37 billion residential loan portfolio, $18 billion, or almost half of it, is tied to rent-stabilized properties. For the past 20 or so years, this worked brilliantly. The landlords made a killing by gradually raising the rent, and almost none of them defaulted on their loans. But this situation couldn't last forever. Over time, the rent-at-rent stabilized properties became less and less affordable. Also, because the landlord can raise rents once the tenant leaves, the landlord wants the tenant to leave. This creates an incentive to conduct the minimum amount of maintenance, leaving the property in a dilapidated state, hoping the tenant will get fed up. In 2019, the New York City government revised the regulations. They eliminated the ability to increase rent during tenant turnovers, and properties can no longer convert to non-stabilized. Furthermore, the ability to increase rents following renovations was capped at just 2% per year. This was disastrous for landlords. The entire strategy of taking out loans to buy rent-stabilized apartments no longer worked. The average price of rent-stabilized apartment buildings has decreased by 34% since the new regulations were enacted in 2019. This is even as non-stabilized property prices have risen. The impact of the rent stabilization reforms took some time to impact NYCB. In most cases, the landlords still generated enough rental income to make their interest payments. But as their loans mature, they may not be able to refinance due to the falling value of their properties. On January 31st, NYCB's share price plunged almost 40% after they disclosed a $250 million net loss for the fourth quarter of 2023. This loss was attributed to increased loan loss reserves for expected defaults in their rent-stabilized real estate loan book. Of their $18 billion of rent-stabilized loans, currently 0.5% of them are non-performing. Non-performing means the borrower is in default. While this isn't so bad, the real problem is that 14% of their loans are criticized. A criticized loan means the borrower has not yet missed any payments, but based on their financial situation, the bank expects that they may default in the near future. Generally, a bank will decline to lend additional money to a borrower that is criticized. For decades, NYCB was considered to be one of the most conservative and well-managed banks. But out of the blue, they take a massive loan loss provision and disclose that a large portion of their loan book is criticized. Why did it take them so long to make the provisions? Shouldn't they have seen that these problems would eventually materialize after the 2019 rent reforms? Shortly after they reported the loss, they also disclosed that they had identified weaknesses in their internal controls related to their internal loan review. This resulted in ineffective oversight, risk management, and monitoring activities. Basically, they were asleep at the wheel. As the financial position of their borrowers was deteriorating, they were seemingly oblivious until the last minute. On February 29th, the CEO resigned, and the bank claims it is taking steps to beef up its internal loan reviews. So how bad could things get? As of the end of 2023, the bank had $8 billion of Tier 1 common equity. Based on the size of their balance sheet, they need to have at least $4 billion of Tier 1 common equity. So if they lose $4 billion, they'll be undercapitalized, and the regulators would likely require them to do a dilutive equity raise. They have $18 billion of loans to rent-stabilized properties. If they suffer net charge-offs on 22% of these loans, their capital cushion would disappear. So while they're still solvent, they're clearly in a precarious position. In March, they raised $1 billion of new capital from a group of investors led by former U.S. Treasury Secretary Steven Mnuchin. This equity raise was done at a distressed price of just $2 per share, and diluted existing shareholders by 40%. The fact that NYCB agreed to those terms shows how desperate they were. While the extra $1 billion certainly helps, given that they have $18 billion of rent-stabilized loans, it's unclear whether even this will be enough. Alright guys, that wraps it up for this video. What do you think about NYCB? Do you think New York's rent stabilization laws are justified, or do they go too far? Let us know in the comments section below. As always, thank you so much for watching, and we'll see you in the next one. Wall Street Millennial, signing out.